I attended the Family Office Summit in New York City this past Friday, and for me it was quite informative and a very good networking event. The group of speakers managed a collective total of about $8 billion in their respective funds. Panel 1, moderated by Camille Hamzi, spoke about the best ways to approach and engage effectively with ultra-wealthy family offices. Here is a recap of 6 fund managers and how they prefer to be approached.
My name is Stephen Abernathy, and I was a financial analyst specializing in healthcare technology for about 15 years. I'm not sure that we'd like to be found too terribly much. By the time we get to the point that we're running a family office, we have an investment process in place, be it good or bad. And most of the time, it's an outbound search that we're looking for. So to the extent that we can find things that we're looking for specifically and match it up with what you have, it's great. If you're contacting us, it would be outstanding if you'd be very transparent and answer the questions that we ask instead of we asking questions and you're answering something else. The fastest way to make an impact with someone is through an introduction of a trusted source. You know, integrity in this business is difficult to come by at times. The financial services industry is probably dug a hole that is so deep that they might not be able to come out of it with the conflict of interest things that go on today. So I would say that, at least for us, the preferred way of having an introduction is through someone that we know and we trust.
I'm Naeem Farah. I work for a single family office in Birmingham, Michigan. I've worked there for the last 3 years. We tend to focus on the Midwest. We don't, not to say that we aren't opportunistic, and if something really attractive comes along, we definitely will entertain it. But we tend to play in the area that we're comfortable in, and we know the Midwest. So we'll delve out in Michigan, definitely, but we'd like to stay within the Midwest territory.
I'm in a position like many other allocators where I'm pitched all day long. I get the one-page email flyers. I get the blasts. I get all the inbound stuff in LinkedIn, and as has been set up here, we have a process for good or for bad, and you really need to kind of understand your target. I think these the blast emails just don't work. If it's an oil deal from Texas and I'm in sitting in Mayfair in London or in Back Bay in Austin, I mean, the first thing I ask myself is how the hell did it miss all the other oil guys in Texas? So it's really about understanding who your audience is.
A lot of it is through networking and sharing deal flow with people that you trust in the industry, client to client collaboration, and then obviously events like this and getting to know people. Sometimes I'll walk away from an event like this with 200 business cards and I forget who those people were. So in a lot of cases, I wait for someone that found our conversation worthwhile to reach out. And then I would also say a lot of what I've looked at historically has came from spin-outs, so people that were at a fund that we invested in. Now they're launching their own fund, and we always look for the new young alpha generating manager.
Being honest and being real. If you come to me and try to do a pitch or try to sell me something straight away without learning who I am, what I want to do, how I do things, it's not going to work. You need to learn me, and I need to learn you, and if there's something that's going to match together and work well, great. But don't do a pitch. Get to know me. I want to get to know you, and then we'll see what happens.
As much as all of us may sit up here and say, inbound pitches and things like that aren't very attractive, I will say for myself, seeing a lot of deal flow is very important to me. That said, there have been times that I've picked up the phone and called Steven because he's an expert in areas that I'm not. I built my business by mistake. prior to knowing what a family office was and through supporting certain charities. So I think it's, softening your sell a little bit, and like everyone else said, just getting to know the person that you want to know for maybe an end goal, but the aggressive approach isn't always the right approach.
The final panel, moderated by Richard Wilson, discusses how $250 million single-family offices manage their investment portfolios. Here's a few short clips.
Where our deal flow comes from, they can come directly, you said, from the family offices themselves, because we see those opportunities. But most of our deal flow will come from our own sourcing. So we go out to, as a group, to over 50 venture-type conferences a year and bring back what I call best of breed. So there are a lot of companies that compete in different spaces like healthcare, energy, and so you have to distinguish which ones are the very best. So we have to filter those particular investments that we see as potentials to bring back the very best deals. So what we've done through the family office network we have is we co-invest directly with the other families. We have opportunities to see the same deals. If they're not at the events, we still show them those opportunities. There is a lead family office, and then they fill in around that lead. So we can do what we call a special purpose vehicle and put them all into one vehicle.
One thing around diligence is I think it's really important to leverage our network to get deal flow, but for us, we try really hard to still do our own diligence, regardless of how trusted the source is. The data to show, specifically in VC, where the weird and wacky things are the ones that make you the really big exits, that consensus-driven decision-making actually doesn't work. So for those of you who are thinking about setting up funds, don't have $100 million managed by 4 people, have them each manage $25 million. The data shows that leads to better VC returns. So I only show that because as much as we trust our network for recommendations, we always do our own diligence. And the really simple framework there is we look at the 4 Ps, right? People, problem, progress, and price. So exactly, as the gentleman said, we look for the most amazing team, domain expertise, thoughtful complementary skill set. We look for really large markets with attractive competitive landscapes.
I've looked for opportunities where there is a clear path to not only revenue, because anybody can make revenue, it's a question of can you make it profitable. And so I've always valued investments based on a clear line to profitability. Investments don't have to be profitable today, but they have to be profitable at some point in the future based on reasonable assumptions that I can see a clear path to get it there. And so that's always been the area that I've focused on, and again, done a lot of fintech investing at different stages in their life cycle. I've done seed investing. I've been the first money in on fintech investing. So I'm not scared to go with something that's even pre-revenue, but I'm scared to go to something that I don't think will ever be profitable. And for those, I mean, in prior conversation, we talked about some things that are just hot right now. And you have to be careful about what's hot. Any of us who've lived through the .com bubble and then burst realize that something just built on a theme with no substance to it is probably not going to last. And so when I get into something, I look for something that has longevity.
Most families or high net worth potential partners, they are very concerned about privacy, about keeping the deal off the market for the benefit of their family and for the security of their family. I am opportunistic in that case. I really be most interested in deals that have divorce, death, family partnership breakup. Those create a situation where you can buy an asset, avoiding that pool of buyers that will compete with you on many deals, regardless of what the EBITDA is, especially in middle market. But in reference to middle market, I have an interest in investing in growth capital with middle market companies, especially if they produce a product that we can help them grow globally, capitalizing on our connections and our contacts worldwide with our other investments, where we can help them grow and help ourselves at the same time.
To summarize, here are the top 10 recommendations from single-family offices on how they prefer to be approached for deals. 1. Most family offices do not like unsolicited contact, either through email or LinkedIn. 2. Be transparent and always answer their DDQ questionnaire. 3. Get introduced to the investor through a trusted source. Just like dating, getting to know the potential date's friend first and then ask him or her to introduce you later. 4. Don't send email blasts or LinkedIn blasts. It makes you look unprofessional and not focused. You are seeking long-term relationships, so don't treat the process as if it were Tinder. 5. Know what the family office invests in. If they clearly invest in oil and gas deals, do not try to pitch them blockchain or hotel deals. 6. Most family offices share deal flow, so networking with the right family office can possibly get you an introduction with another family office in your sector. 7. Do not introduce yourself at a networking event and immediately straight out pitch a deal. Introduce yourself and get to know them first. In some instances, it takes over a year before a family office will even consider investing in your deal. Think of it as a first date and not the 5th date. 8. Family offices look for best of breed, meaning you have to be the absolute best in your investment category. 9. The deal must establish a clear path of profitability. Otherwise, it's not an investment. And finally, 10. Does your investment have a clear path to a liquidity event like a sale or acquisition? There you have it. The top 10 networking tips on how to initiate contact with a single family office investor. Thank you for watching.